At Kane Anderson Rudnick, Michael Kushma, CIO of Global Fixed Income at Morgan Stanley Investment Management, Greg Ip, Chief Economics Commentator at the Wall Street Journal. Welcome to all of you. Greg, let me start with you since you're sitting right on my right hand here. You think that the Fed could actually raise rates even more without damaging the economy. Is that what you favor them doing?
Well, if you look at the current configuration of rates and what the economy is doing, it's hard to make the case that they've managed to accomplish a lot. Inflation, core inflation seems very sort of sticky around the 4 to 5% area. The economy seems to be doing just fine. Very strong job growth. And look, the stock market is up 22%. Like in my book, that is not the sign of a market that's worried about like a really vice-like grip coming from the Fed.
And you look at the regular CPI, including energy, and you look at energy, and it was one of the main reasons that number came down as much as it did.
Right. So I think people might be getting a bit of a head fake. It's great that the overall inflation rate's down from 9 to 4%. But we know from years of covering this that the underlying trend is better arrived at by getting rid of the food and energy components. That gives you 5%. Now, take out some of the other stuff that's a little funky, like shelter, cars, and so forth. You end up with something that's we're calling supercore, and that's like running at 4 or 5%. And none of those numbers are anywhere remotely close to what the Fed wants, 2%. So that's why I think that there's a bit of a reality check in order.
Michael Kushma, give us your setup here with 2 minutes to go quickly.
Sure. I think there's a good case. I think 60-40 that they pause, or I should say skip. Skipping me. I think skipping is different than pausing. Pausing may mean they're stopping. Skipping means we're still in the process of raising rates, but we've done enough. Let's take a pause and see how things are playing out. Inflation has come down a lot, as Greg said, but on the other hand, major components of it are not decelerating very fast. And if you compare today's data with what they were projecting back in March, the last time they put together their projections, inflation's higher than expected, unemployment's lower than expected, growth is stronger than expected. So from those perspectives, you would say their job is not done, but we're getting close.
Julie, let me ask you, as you know, if this is a castle built on sand, as we emphasize the strength of the market, we're also approaching, the 15% post-inversion rally everyone said we should expect. So do we have this run its course and then revert to the bear market as the economy slows?
I think it's going to actually be sector specific. I think there are already pockets of the S&P that are in a clear earnings decline, where margins have been super pressured by not just overall commodity price increases, but wages as well. And so it hasn't really rippled throughout the economy, but I think there's going to continue to be these uneven sections. So unlike most recessions where we kind of all move together in concert, I actually think there are going to be these puts and takes and delays. And that makes it really hard to kind of know where the direction and the leadership should be in the market.
Greg, we have about 40 seconds before we go to Steve. What kind of language should we be looking for in the statement and then in the press conference?
Will they talk about additional policy firming still to be needed? If so, I think that's, first of all, at least a broad hint that there probably are more rate hikes to come. I want to see if they revise up the terminal rate forecast in the projections that they give us. There's a good chance that even if they pause here, the signal from the statement and from that those projections are that they think they have 1 or 2 more to go.